The government needs to borrow money to finance its spending and pay its debts. One way it does this is by issuing treasury bills, or T-bills, which are short-term debt obligations backed by the U.S. Treasury Department. T-bills have a maturity of 1 year or less, and they are sold at a discount from their face value. This means that investors pay less than the amount they will receive when the T-bill matures. For example, an investor might buy a $1,000 T-bill for $950. When the T-bill matures, the investor will receive $1,000, which is the face value of the T-bill. The difference between the purchase price and the face value is the interest earned by the investor. In this case, the interest is $50, which is equivalent to an annualized yield of 5.26%. The government sells T-bills through auctions conducted by the Federal Reserve Bank of New York. There are two types of bids, competitive and non-competitive. Competitive bidders specify the amount and the yield they are willing to accept. Non-competitive bidders agree to accept the average yield of all the competitive bids. The Fed allocates the available T-bills to the highest bidders until they are all sold. The demand and supply of T-bills determine their yield in the market. When there is high demand for T-bills, their price goes up and their yield goes down. When there is low demand for T-bills, their price goes down and their yield goes up. The government can increase the supply of T-bills in the market to meet its borrowing needs by issuing more T-bills or selling existing ones from its portfolio. This can have several effects on the economy. First, increasing the supply of T-bills can lower their yield and make them less attractive to investors. This can encourage investors to shift their money to other assets that offer higher returns, such as stocks, bonds, or commodities. This can stimulate economic activity and growth. Second, increasing the supply of T-bills can increase the amount of money in circulation. This is because when the government sells T-bills to banks or individuals, it pays them with newly created money that adds to their reserves or deposits. This can increase the money supply and create inflationary pressure. Third, increasing the supply of T-bills can affect the interest rates in the economy. This is because all interest rates tend to move together with the federal funds rate, which is the rate that banks charge each other for overnight loans of reserves. The Fed controls this rate by buying and selling T-bills in what is called open market operations. When the Fed buys T-bills from banks, it increases their reserves and lowers the federal funds rate. When the Fed sells T-bills to banks, it decreases their reserves and raises the federal funds rate. The federal funds rate influences other interest rates in the economy, such as mortgage rates, car loan rates, credit card rates, and so on. Lower interest rates can stimulate borrowing and spending by consumers and businesses, while higher interest rates can discourage borrowing and spending. In summary, by increasing the supply of T-bills in the market, the government can raise money to finance its spending and debt obligations. However, this can also have various effects on the economy, such as lowering or raising interest rates, stimulating or slowing down economic activity, and creating or reducing inflationary pressure. In this section, we will explain how the government used open market operations and reverse repo auctions to manage the liquidity and interest rates in the market. Open market operations are transactions in which the central bank buys or sells securities in the open market to influence the supply and demand of money. By doing so, the central bank can affect the short-term interest rates that banks charge each other for borrowing and lending reserves. Reverse repo auctions are a type of open market operation in which the central bank sells securities to eligible counterparties with an agreement to buy them back at a later date. This reduces the amount of reserves available in the banking system and puts upward pressure on interest rates. The government used these tools to clear the treasury bills, T-bills, with lower rates by draining excess liquidity from the market and creating demand for the T-bills. The government issued a large amount of T-bills to finance its spending and deficit, which increased the supply of government securities in the market. This could have lowered the prices and raised the yields of the T-bills, making them more expensive for the government to borrow. To prevent this, the government instructed the central bank to conduct reverse repo auctions with a large volume and a low offering rate. This attracted many investors who had excess cash and were looking for a safe and short-term investment. By selling securities to these investors, the central bank removed liquidity from the market and created a shortage of reserves. This pushed up the short-term interest rates and made the T-bills more attractive relative to other assets. As a result, the government was able to sell the T-bills with lower rates and lower borrowing costs. The reverse repo auctions also helped stabilize the overnight interest rates within the target range set by the central bank. The central bank could adjust the volume, rate, and maturity of the reverse repo auctions depending on the market conditions and its policy objectives. The government benefited from lower rates and higher demand for T-bills from banks and investors in several ways. First, lower rates meant that the government could borrow money more cheaply and reduce its interest expenses. This helped the government to finance its budget deficit and stimulate the economy. Second, higher demand for T-bills meant that the government could sell more of them and raise more funds. This also helped the government to meet its debt obligations and avoid defaulting. Third, higher demand for T-bills also reflected the confidence of the market in the government's creditworthiness and stability. This boosted the government's reputation and credibility among domestic and foreign investors. Fourth, higher demand for T-bills also lowered the yields of other government securities, such as treasury notes and bonds. This made them more attractive to investors who were looking for longer-term and higher-return investments. This increased the demand and liquidity of the government's debt market and lowered its borrowing costs further. Fifth, higher demand for T-bills also created a positive spillover effect on other sectors of the economy, such as corporate bonds, mortgages, and consumer loans. As the yields of these securities followed the downward trend of T-bills, they became more affordable and accessible to borrowers and lenders. This stimulated economic activity and growth in various industries and sectors.